Hello, everyone. Today we are answering a fundamental question for income investors. What is dividend yield? By the end of this presentation, you will understand exactly how your cash return is calculated. Let's start with a scenario. Have you ever heard someone say, "This stock has a 4% yield"? And you wondered, is that good or is that bad? If you like the idea of getting paid cash just for holding a stock, dividend yield is a term you really want to understand. In this session, we will break it down into simple pieces. First, the definition. Dividend yield tells you how much cash a company pays you each year relative to the price you pay for the stock. In plain language, the formula is the yearly dividend per share divided by the current share price. Let's see this in action with real numbers. Imagine a stock that pays $2 per share in dividends every year, and the current price to buy one share is $40. To get the yield, we divide 2 by 40, which equals 0.05. That is a 5% yield. This means for every $100 you invest, you'd receive about $5 back in cash over the year. But let's back up. Step 1. What actually is a dividend? It starts with company profits. The company decides to share those profits by sending cash payments directly to the shareholders. Keep in mind, not every company does this. Many growing companies prefer to keep that money to reinvest in their own growth. Step 2 is finding the yearly dividend. Most companies pay quarterly. If a company pays 50 cents a quarter, you have to do a little math. You add Q1, Q2, Q3, and Q4 together to get the total annual amount, in this case, $2. Step 3 is the most important concept. The yield moves when the stock price moves. If the stock price falls to $20, but they still pay that $2 dividend, the math changes. 2 divided by 20 is 0.10. The yield effectively jumps to 10%. Conversely, if the price shoots up to $100, that same $2 dividend is now a much smaller percentage of your investment. The yield drops to 2%. So how do investors use this number? It gives us clues about the market's view. A very low yield might mean the price is high because people expect growth. However, a very high yield can be a double-edged sword. It's either a great opportunity or a warning sign. This brings us to the danger zone. Let's look at the common mistakes beginners make. Mistake number 1 is chasing the highest yield. The trap is picking a stock just because you see a massive number, like 12%. Here is the reality check. A sky-high yield often means the price has crashed because investors expect the dividend to be cut. A 12% yield that gets cut to 0 is a terrible investment. Mistake number 2 is ignoring safety. Remember, yield tells you the size of the check, not the safety of the check. Always check the history. Have they paid it consistently? Check earnings. Do they actually have the money? And check the payout ratio. Mistake number 3 is forgetting about total return. Total return is the dividend plus the change in stock price. Look at scenario A. A small 2% yield with price growth gives you a 10% return. Compare that to scenario B, a huge 8% yield, but the stock drops 10%. You actually lost money. Don't let a high yield blind you to price drops. Finally, two quick ones. Don't confuse dividends with bank interest. Bank interest is usually guaranteed. Dividends can be canceled at any time. And always check the dates. Just because the yield is annual doesn't mean you get paid tomorrow. Know the schedule. Let's recap what we've learned. The formula is yearly dividend divided by share price. Higher yield means more income, but potentially higher risk. Lower yield usually signals growth or reinvestment. The best strategy is to look at the total picture, not just the percentage. As always, this is for educational purposes only. Please do your own research before investing. Thank you for watching.